Good morning, everyone. My name is Charene Nortier. I am from the Conduct of Business Supervision Division at the FSCA, and that is always such a mouthful. We are the supervisors of the FSCA, and we are incredibly glad that you joined us for this workshop today on the General Code of Conduct in terms of the FAIS legislation. I have a couple of presenters, and I will tell you who they are today. We're very pleased that they made the time to join us and to share their insights on the General Code with you as well. There's always a couple of housekeeping arrangements. So let's just talk about the housekeeping arrangement. As with everyone else in the country, we are not exempt from load shedding. So I am expecting that we are going to do a switch over on power about an hour into the session. If that happens, please don't go away. Just give us about 2 minutes. It takes about 2 minutes to switch over, and then we'll be able to continue. So about an hour in, we are expecting to just switch over on the load shedding system. Then we have some fantastic news. We have managed to accredit this workshop as well as the workshop of Thursday, the upcoming workshop on FSPs and representatives with the Financial Planning Institute for CPD purposes. So this workshop for today will give you 2 hours or 2 CPD points for your CPD records, provided that you complete the assessment. So how the assessment is going to work is that we are recording this workshop. We will be hosting the workshop on the FSCA YouTube channel. I hope that the YouTube channel that we host is your top favorite channel of all times, with the most hits from your specific computer or TV, that you visit us often, because we have such a wide variety of webinars and workshops available on the YouTube channel. But with the link to this recording that we will host on the YouTube channel, there will then be a link to complete the assessment as well. Once you've completed the assessment successfully, you will then automatically generate your own certificate, which you must keep for your own records, as well as provide your FSP with a copy of that so that they can update the competence register. For those of you who have already completed your CPD hours for the current CPD cycle, which is due to expire on the 31st of May, just a quick reminder, CPD cycle runs from 1 June of 1 year to 31 May of the next year. So we've got about 2 months left of this CPD cycle. So if you already have all the points that you need, well done and congratulations. But you can then defer your assessment of this workshop to the 1st of June or thereafter, and then you can do your assessment so that it counts towards your new CPD cycles points. So you could choose how you're going to do this. Our assessment is valid for 12 months, that you can access the assessment and get your valid CPD points from March of this year to March of next year. So you can decide into which CPD cycle you want to actually complete the assessment and then allocate your CPD recognition. And then just to talk about our presenters again, we have apologies, 3 presenters with us today. We have Thandiwe Malefo, Matshidiso Malgas, and we will be finishing off with Master Swarts. So without any further ado, I think let's kick off, and I'm going to hand over the presentation to Thandi. Thandi, thank you so much for joining us today, and I look forward to this presentation. Sorry, it's Monday morning, so we have a slight technical glitch. We are just sorting that out with Thandi. So please just hold on for us for 2 minutes.
Thank you, Charene. Charene, I still need help with the sharing tool.
Thandi, we can see you, but we can't hear you. So please just bear with us for a minute. There you are.
Can you hear me now?
Yes, we can.
All right. I still don't have access to the sharing tool, so I cannot share the slides.
Thandi, just hold on 2 seconds. Let's just try that again.
Thank you. It's reflecting now. Thank you for that. Please let me know when you can see the slides.
The slides are on, Thandi.
Okay. Thank you, Charene. Okay. Sorry about that. Sorry for the delay, everyone. I'm just trying to find my presenter view. Okay.
Thandi, the slides have disappeared again.
Have they disappeared?
Yes.
Okay, I'm going to try again. I'm going to stop projecting and then try projecting again. Can you see them now?
Not yet.
Not yet. Okay, I'm going to try again.
We have the slides, Thandi.
You have the slides. Thank you so much for that confirmation. Okay. Welcome everyone to the session that we're about to have today. We will be covering the changes that came about in the General Code of Conduct that were presented in Board Notice 706 of 2020, as well as the changes that were presented in Board Notice 2814 of 2022 on the 1st of December 2022. We are also going to highlight the findings and industry trends that we have identified as the FSCA. Okay. As Charene mentioned, my name is Thandiwe Malefo, and I am a specialist analyst from the Financial Advisors and Intermediaries team. Sorry, I'm having difficulty with moving these slides. I'm so sorry for that. I'm not sure what's happening. Okay. Sorry about the inconvenience there. All right, so just to get into the definitions, so there are a few definitions that changed from Board Notice 706 of Board Notice 706 of 2020, and the amended definitions are on the advertisement, on the definition of a company, direct marketing, financial interest holding company, and what is deemed as material. Now, there are also definitions that were completely new, and we are not necessarily going to go through all of these. We will just go through the amended definitions, as the new definitions are embedded in the changes that we will discuss throughout the workshop. We have also highlighted these for the FSPs to go back to their respective policies and to ensure that they have amended these to include the new definitions, as well as the additional requirements that we are going to share with you today. So in terms of the amended definitions, the definition for company and holding company are aligned to the definitions that are stipulated in the Companies Act of 2008. And in terms of the definition of advertisement, this means any communication that is published intended to create public interest, a business or financial services or financial products related services to a provider, or to persuade the public to transact in respect of a financial product. Financial service or related service of the provider, but does not purport to provide a detailed information or to the specific client regarding the specific financial product. So meaning it doesn't refer to brochures and that. Direct marketing then means the rendering of financial services by way of telephone, internet, digital application platform, media insert, direct or electronic mail, but excludes the publication of advertisement. So that is what the definition of direct marketing has been amended to. The definition of financial interest has been amended to read as follows. It means any cash equivalent, voucher, gift, service, advantage, benefit, discount, domestic, foreign travel, hospitality, accommodation, sponsorship, or any other incentive of valuable consideration other than that of ownership interest or training that is not available to a select group of people. So that is what is seen as financial interest. Now, with the newer definitions, as I've said before, my colleagues and I will speak through most of these definitions in the new material that we will present to you. Okay, we will start with the sections 2 and section 3, subsection 1A. These are not changes at all, but the general and specific duties of the provider when providing a financial service. We needed to highlight some of these, even though they are not new, because we are seeing that some FSPs or some providers are not necessarily aware of these duties or tend to forget these duties. And we just wanted to use this opportunity to highlight these. Now, section 2 of section 2 relates to the general duties of an FSP. There's a huge responsibility to provide the financial services with honesty, fairness, with due skill, care, and diligence at all time, and in the interest of your clients, as well as the integrity of the financial services industry. This means that FSPs are expected to conduct the necessary due diligence on any third party that they choose to engage with. They need to assess how their general reputation is, what their claims payment history looks like, what is their complaints resolution history and process, as well as timeline, as well as turnaround. It's also important to look at whether that particular third party specializes in the product that you are selling to those clients, whether the product is accessible, and whether clients are able to actually reach the product provider or the service provider. It's also important to look at the longevity of that service provider in the industry and whether they are financially sound, because that is probably a good sign that they will not be prone to finding reasons to repudiate claims when there are no reasons to do so. And now also in looking at representations and information, information provided to a client by a provider, it must be factually correct. It must be in simple language that the client can understand. It must be geared at the right level of understanding and education of that particular client. For instance, for a low income segment and low cost product, you would expect that those kinds of products, the jargon on those kinds of products should not be very legal. They should be very simple and reduced to the simplest form of English or language for the user to be able to understand what they are getting into and what that product what that product has in terms of benefits. It's also important to provide information on all monetary terms and numerical terms. So whether there's a waiting period, whether there's money or access fees that are payable, those are things that need to be stipulated in those documentations. Then we will look at the conflict of interest. And basically what is expected of an FSP in terms of conflict of interest. FSPs and its representatives are to avoid and mitigate any situation in which there's actual or potential conflict of interest that can influence the objective performance of their obligations to the client, that can prevent the FSP or representative from rendering an unbiased and fair financial service, or that can prevent the financial service provider or representative from acting in the best interest of that client, and also where an FSP or the representative has ownership interest or a relation in a third party. A relation in a third party could mean something, could be, for example, a representative who may have a spouse who holds a significant ownership interest in a service provider or who holds a senior position. Now, it's important also to realize that not all risks can be avoided. And where the risks cannot be avoided, it is important for the FSP to disclose to the client in writing the measures that they have taken to avoid and mitigate the conflict in terms of their policy, any ownership interest or financial interest other than that, those that are not deemed as immaterial financial interest that the provider or representative may be eligible to. I will get into the definition of what is deemed as immaterial, and the nature of any relationship or arrangement that can pose a conflict of interest. Okay, services to the client must be provided per the instruction of the client where reasonably possible. They must be given priority over those of the FSPs or the representatives. The transactions must be accurately accounted for, and the FSP must be honest and fair to its clients and advise them to the best possible products and not use any information that is available to that FSP or representative to mislead a client into taking a service or product that may not be the most suitable or equitable for the product or for the client. Now we get into the record keeping. FSPs must have the appropriate procedures in place to record verbal and written communication in accordance with Section 15 of the Act, which Matshidiso will unpack in further detail in the next segment of this workshop. Client records and documents must be kept safe from destruction, loss, or theft and be easily accessible upon request. So these records must also be kept for at least 5 years after the termination of a business relationship with the client. So not only are they required during the duration of that relationship, for 5 years after that business relationship has ended. And then in terms of records that are kept with a third party, these must be available for inspection within 7 days at the authority's request. So it is not prohibited for FSPs to keep information with third parties, and in the instances that you have, ensure that that third party enables you to receive that information, and that goes into your testing of your processes. So you need to, from time to time, request information from that third party to actually ensure that you are able to recover that information within the time that is required of you. And then in terms of all electronic and voice recorded formats records, these must be easily reduced to writing or to printed form. So you are permitted to keep voice recordings as part of your record keeping. However, these must be easily reduced to writing. Sorry, I'm still trying to move to the next slide. Apologies for these technical glitches. I'm just not sure why everything, the system is just not working with us today. However, we will move on to the client consent. This is a very, very important slide. So we haven't gone into the changes yet, but this is where we are seeing a lot of breaches and a lot of areas where we need to remind the industry on the importance of observing some of these provisions that we are laboring on now. So FSPs are not allowed to disclose any confidential information obtained from a client or product supplier in relation to such a client or product supplier without their written consent. That is very, very important to note. They can disclose this information if prior consent has been given by that particular client or product supplier to share such information with third parties or partners, or sharing information that is required by law or that is in the public interest. All right. Where consent has been given prior to sharing the information, it must only be used to the extent of the permission that is granted. So if the permission was only granted for the FSP to call the client whenever there are promotions or whenever there are additional, there's additional information that they would like to share with the client, that is the only way in which that information may be used. The information may not be used to sell off to another person or to sell off to, your partners without prior consent of those clients. My colleague Martha will tackle this further in relation to the termination of agreements or business relationships, as well as the lapsing of FSP licensing in the third segment of this workshop. We see the trend in providers selling client information, as well as a surge in bulk transfers, and this is prohibited by the law, as well as, and it's also a contravention of the POPI Act. Okay. So we're in doubt about the type of information that you may want to share with other people. Please go back to your contracts and your mandates and to the permissions that your clients may have given you, just to make sure that you're not contravening their rights and that you're not breaching any their right to confidentiality. All right. So Section 4 speaks to the fact that where FSPs provide any other service that are not financial services as defined, the FSP must expressly state that these services are not financial services. This disclosure must also be made in accordance with Section 7, subsection 5, to alert the client that they are not afforded the same protections in respect of those additional products or services that may apply in respect of the products or services governed by this Act. This is an additional disclosure that came in Board Notice 2814 of 2022. An example may be where an FSP also provides tax filing as well as accounting services on the side that are provided over and above the financial service, or provides NCR products and services. For those particular services, you need to state clearly that these are not financial services. And also now, an FSP may not describe itself as independent if it is tied or linked to a particular service provider and its supplier group. This ties into the disclosures that must be made in terms of the conflict of interest policy. The FSP must disclose, particularly where it earns more than 30% of its commission from one product supplier, or if it's a linked FSP to sell products for that one supplier group. Now we will go into financial interest and conflict of interest management policy. This is where the changes to the general code actually start. So this is where you may need to relook at those codes if you have not already taken the opportunity to do so. There are several changes in the section pertaining to the type of financial interest that a financial service provider or a representative may receive or offer that were presented in Board Notice 706 of 2020. The changes to Section 3A were necessitated by the number of FSPs, more especially in the motor industry, that were receiving incentives, including vouchers for selling specific products of a product supplier. Some of these vouchers could be exchanged for tangible goods that exceeded the immaterial financial interest threshold of 1,000 Rand per calendar year. It is very important for for FSPs to maintain a conflict of interest register and to encourage its employees to declare any such financial interest wherever it is received. I will unpack these changes in detail in the next 3 slides, and I need to stress that that it is important for FSPs to familiarize themselves with the new subsections and to understand the impact that these will have on the existing policies of the FSP and the responsibilities of the FSPs in this regard. So this section is a mouthful. Unfortunately, the general code is very legal in its nature, and it's very hard to actually go into these without actually going into the sections themselves, because it will be difficult for you to be able to reference back. However, these sessions are recorded, and while a lot of the information might go over your heads, you do have the opportunity to go back to the sessions once they are posted, to actually revisit these sections and unpack them alongside what you are reading. All right, so the changes that occurred to section 3, capital A, subsection 1A. The only changes that came about are on Roman numericals 3, 4, and 5. So this pertains to the fees received or offered by the FSP or representatives. The changes that came in state that the fees must be reasonably commensurate to the service that is being rendered. And that the fees and this relates to the fees other than those that are authorized under the so the additional thing that was added here in subsection in Roman numericals 3 was that the fees that other than commission or fees that are authorized under the Long-Term Insurance Act, the Short-Term Insurance Act, as well as the Medical Schemes Act, must stipulate the amount, frequency, payment method, recipient of fees, the details of services rendered, and must be agreed on by the client in writing. There should be no barriers there should be no barriers in stopping the fees in accordance with the treating customers fairly principles on the client. So the clients must be able to stop these fees at any point in time. And any fees or remuneration for rendering services to a third party must comply with the immaterial financial interest, which is defined in the code as any financial interest with a determinable, sorry for that movement, with the determinable monetary value, the aggregate of which does not exceed 1,000 Rand in a calendar year from the same third party in that calendar year. So it's 1,000 Rand per calendar year per third party. Right. Now we move on to the financial interest provided to representatives. In other words, every transaction or service that is provided to a client must have the treating customers fairly outcomes embedded in them. This is where the client needs analysis comes in. The product suitability assessment comes in, as well as the relevant disclosures such as being a linked FSP and not being able to provide a client with product options from different suppliers. So any financial interest must be determined with reference to the quantity of business without due regard to the delivery of fair outcomes to clients. So we must not put the financial interest of the representative above that of the client. It needs to be determined, must not be determined for giving preference to a specific product supplier over another, and it must also not be give preference to one product of a product supplier over another product. Say, for instance, where there is a higher commission, there's a chance of the representative receiving more commission from one product versus another. If that particular product that gives more commission is not suitable to the client per the needs analysis, then it is not appropriate for the client to pitch that product to the client, for the representative to pitch the product to the client, they need to ensure that the advice is linked to the suitability analysis. And this is where the importance of giving appropriate advice and the right information on the product's performance as well as expectations, comes in. And Matshidiso will unpack this in the next segment. This is also where the oversight of the management as well as the key individuals comes in. It is imperative to assess that all documentations and all products are onboarded with the fair outcomes to the clients in mind. The FSP must also be able to demonstrate that determining the financial interest takes into account measurable indicators, that the minimum service level standards in respect of clients are being catered for, that the delivery of fair outcomes to clients are embedded in the advice as well as in the financial interest that is being received or that is payable to the representative. And the quality of the representative's compliance with the FAIS laws is important in this matter. And it is important to ensure that the FSP is also applying its mitigation tools to ensure that the conflict of interest policy has been applied in all the product engagements. We now move on to FSPs and representatives, where they offer or receive financial interest as well as sign-on bonuses. FSPs and representatives, where if FSPs and representatives offer or receive financial interest, the financial interest must be reasonably commensurate to the service being rendered. So meaning it must be in line with industry norms. It must not deter the objectivity of that FSP or the representative. And it's important to also ensure that an FSP or representative does not get paid twice for the same service or a similar service. So where an advice or intermediary fee is already embedded in the commission that is received from the product supplier, the FSP cannot charge the client separately for that same advice and intermediary fee that is still being received in the form of commission or fees from the product supplier. And then it's important to ensure that any actual and potential conflicts are mitigated in line with the conflict of management policy, and that payment of financial interest do not impede the delivery of fair outcomes to clients. So in other words, if representatives should not receive more, should not be encouraged, but with incentives, should not be incentivized for selling one product over another. They should also not be incentivized for selling for selling products of one product supplier over another. And then when we talk about sign-on bonuses, I'd like to actually go into the definition of sign-on bonuses. Sign-on bonus is any financial interest that is offered or received directly or indirectly, upfront or deferred, and with or without conditions, as an incentive to become a provider or representative of a product supplier. The purpose of this sign-on bonus is to assist new entrants to cover their startup costs and to ease their financial burden. Now, it is prohibited for FSPs that have been in the industry, that are already in the industry, to receive a sign-on bonus from a service provider. No person may offer the sign-on product to any person except for new entrants. And now a new entrant is defined as a person who has never been authorized as a FSP or appointed as a representative by an FSP. So an example would be where product suppliers are offered sign-on bonuses ahead of future business commission, i.e., for example, for a period of 24 months. This ends up having a negative impact when clients do not keep their policies for with the product supplier for the minimum amount of time that may be stipulated in that sign-on in the conditions of that sign-on bonus. And this then ends up just causing a ripple effect in the honesty and integrity of how the financial services are being conducted. So where FSPs are receiving these, they must be aware that these are not lawful and that they should, you know, refrain from entering into those kinds of arrangements unless if they are new entrants as defined. And now we look at the conflict of interest management policy. It's very important that FSPs train their staff on the conflict of interest policy and that their staff know where to actually access this policy. The policy must provide for the financial service provider and its representative, must provide the FSP and its representatives with measures and tools to identify any areas of conflict. It must help these the FSP as well as its representatives to avoid conflicts of interest, and where not possible, provide the reasons why avoidance is not possible. For example, as I mentioned earlier, where a representative may have a spouse that holds a senior position with the product supplier, or where the FSP may hold a significant interest in that product supplier, or the product supplier holds a significant interest in that FSP. Those are the types of disclosures that need to be made where they cannot be avoided. The FSP needs to then say what measures it will take to mitigate those conflicts to an acceptable level. It is important as well to disclose that those conflicts, as I have mentioned earlier, and to outline the processes and procedures and internal controls that will facilitate the compliance with this policy. It's also important to stipulate the consequences of non-compliance with the policy by the FSP as well as its employees. So the policy must state what the actionable outcome is for non-compliance. And that concludes my segment. I know it is a lot to take in, as I have said before. However, we are recording the session and you will be able to revisit this discussion. And we will now afford you the platform to ask questions.
Christine, you have mic access, and then Carlia thereafter. So, Christine, please unmute yourself and ask your question.
I just wanted to say that I didn't get it. I couldn't see the presentation. I only saw the lady sitting on the white chairs. That's all I see. Is the presentation going to be available afterwards?
So we will make the presentation available with the recording on the YouTube channel. It takes us about a week to sort that out. So what I would suggest is when we send out the communication notice with the links, which hopefully will be within the next 10 days, you will then get the presentation link as well as the YouTube channel recording, as well as the link to the assessment.
Okay, thank you.
Pleasure. Carlia?
Oh, thanks, Charene. Thanks, Thandi. Charene, my question relates to sign-on bonuses and new juristic entrants into the market. So on the one hand, you have a new entrant where you're allowed to assist them with startup costs, etc. But on the other hand, the juristic rep has financial soundness requirements that they must meet. And how do those two marry each other?
Okay, so Thandi, I'm going to ask you to jump in as well at any stage, but Carlia, let me start off with. So first of all, we don't allow sign-on bonuses, and we haven't allowed this for quite a while. So if any business is still offering a sign-on bonus, please understand that you are in breach of the general code.
Sorry,
and
Charene, it's not a sign-on bonus. It's a startup loan.
Okay, so sign-on bonuses, it's a problem. I want to see an irregularity report, please, from the compliance officers. You can see Thandi on that as well. So Thandi, I'm sorry, Thandi. Kadia, we understand that businesses start up with a sign-on loan, whether it is from an external party or whether it is from the shareholder. We see those on the balance sheets. What we do want to see is your business plan and how you are going to resolve that situation. So we are pretty lenient on the first year, but of course this is a case-by-case management. Because some sign-on bonuses are small and the people are in a position to sort that out, repay the shareholders' loan within the first year. Other loans are huge and it will take 10 years plus to sort that out. So there we actually need to have a formal exemption application. So we can't give you an amount because it depends on what the amount of the loan is that you start up with. It depends on what your business plan is, what your projections are for the future, and also just literally your ability to actually make your plan work and start repaying this. So what we suggest is that a new business contacts us, because for every business, that business has a dedicated analyst, and let's walk the journey with you. Let's take a look with you at your business plan. Let's take a look at what you're planning to do, how you're executing it. We actually monitor it with you, which I know is a pain, but that having to formally notify us every 3 months of what has happened in the last 3 months, it's a very good business practice and a very good exercise for businesses because it focuses their attention. So we really walk and work with the small business to see how can we get them from startup, not having any income, to where they have an income and they can start managing their income stream as well as their loan reduction. And then we see whether it is necessary to apply for an exemption or not. I hope that I've answered you, and if any of my colleagues have any things that they want to add, please do so.
Thanks, Charene. Yeah, that answers my question. And yeah, as you know, juristic reps, I mean, our life is big, so we'll contact our dedicated analyst for next steps on this. Thank you so much.
Perfect. Thanks. Obadia, I see that you have raised your hand. You have mic access. Please unmute and go ahead. Obadia, you can unmute your microphone at the top right-hand corner of your screen, and then you can talk to us. It looks as if Obadia might have a small technical problem. So for those of you who have been typing your questions in the chat function, we are also in the fortunate position that we have colleagues who are participating by trying to respond to every single question that we have in the chat function as well. So Obadia, it looks as if you have a problem with unmuting your microphone. Okay, Adrian, you were here and I see you've just disappeared. Would you like to raise your hand again so that we can give you mic access? Adrian, you have, or Adrian, you have mic access. Please go ahead.
Hi, sorry. I did hear that you said that the slides will be made available. I just wanted to know, is there a register that we need to complete? It's been asked by a number of people, so that's my question.
Thanks, Adrian, for that. We can download an automatic register for all the people that have attended. So thank you very much for that. We don't have to. You don't get CPD points for attending. You only get your CPD points for actually completing the assessment. which is why whether you're attending live today or for those people who are only accessing the recording, you will have to access the assessment that we will post with the recording. And then you will be able to get your CPD points, because that's normally the next question. So how do I access my CPD points? The rules have changed a little bit from the professional body side. So we now need to not only prove attendance, but we actually have to prove that you've completed the assessment. Thanks,
Okay.
Adrian. Then
Thank you.
Christy,
Yes, you
thank
cleared
you.
it up. Thank you.
Excellent. Christy, you have mic access. Please go ahead. Christy, you can unmute yourself and ask your question.
Sorry, just had a problem to unmute there. My question relates to a conflict of interest where there are a non-regulated portion within the premium of a regulated product. So in other words, the requirements in terms of conflict of interest are met in terms of the regulated portion, but within the unregulated portion, there are often sometimes a additional voucher or reward for the respective person selling the product. And the providers simply say that it's not a regulated product and they are allowed to do that. Do you still see that as a potential conflict of interest?
Christy, you know, being a regulator, we take the belts and braces approach, so we make sure that hopefully everything stays in place. So what I would do there is have a very, very clear register where you record everything and you make the differentiation between what was related to the financial product as defined in FAIS and what was related to the product that is not covered by the FAIS legislation, and disclose that to the client as well. The way that we always say disclose, so that if you can avoid, if you can't avoid, then mitigate and disclose. So I would still take that approach and make sure that my register records it and makes it very clear why something was accepted and why it was provided to your representatives or your staff members, and why certain things were declined and not offered because it would have breached the conflict of interest requirements.
Thank you very much.
Pleasure. Any other hands? Okay, I don't see any. Okay, Obadia is trying again. So Obadia, you have mic access? Obadia, at the top right-hand corner of your screen, you should see a microphone. If you click on that, you should be able to unmute yourself and talk to us. Okay, Obadia, it looks as if we have a problem. So what I can suggest is that you type your question in the chat function and we'll make sure that you get an answer. Then Josiah, you have mic access.
Can you hear me?
Yes, I can.
Okay. Maybe just for my benefit, can we define what we mean by a sign-on bonus? Because what happens where you get some sort of long-term incentive, so commensurate with you achieving specific objectives over a particular period, you are assigned a particular monetary reward. So technically, it's not a sign-on bonus, but in my mind, technically, it is a bonus, if that makes sense.
So, Josiah, that's a really good question. Thandi, do you want to take it?
Sorry, Charene, I missed the question.
Josiah just asked us to talk about what is a sign-on bonus.
Okay. All right, Josiah, in the general, so I'm going on the definition that is in the general code, right? It's going to go in there. Okay, so it says any financial interest offered or received directly or indirectly, upfront or deferred, and with or without conditions as an incentive to provide a provider or representative of a product supplier, the purpose of which is to assist new entrants to cover up their startup costs and ease their financial burden. So that is any amount that is extended to a financial service provider for, for whatever purposes, to incentivize them to sign on with them. Does that answer your question, or do you need?
Thank you, Thandi.
Josiah would, okay, sorry. I don't know if I need to phrase it differently. Okay.
No, Thandi, I think we're okay there. I saw a hand very briefly, but it's disappeared. So I think in the interest of time, Jock, we're going to give you mic access, and then we are going to take a quick 5-minute break after that, and then we will carry on with the next section. So Jock, you can go ahead.
Thank you very much. I just wanted to ask, do all these disclosures also relate to agents who work under scripted execution of sales or tier 2 products, non-advice?
Yes. Yes. It applies to all. It applies to all FSPs. So if you saw in the specific and general requirements of FSPs, it says that all providers. So that's basically all FSPs. This applies to all FSPs. The only relaxations I think that we can think about are in the determination of fit and proper. So in the general code, there are no relaxations on the tier 1s and 2s, unless if I stand to be corrected. But I know the relaxations are on the determination of fit and proper, but not in the general code.
All right, thank you.
All right.
Thank you very much. So my clock says it's 4 minutes to 9. So I think let's give everyone a 9-minute leg stretch and come back at 5 minutes past 10. And then Matshidiso is going to take us through the next session. Thandi, thank you very much.
Thank you.
And if you have questions,
Please
please remember that you can post your questions in the chat function as well. We will give a chance for verbal questions at the end of each speaker's presentation. So we will see you back at 5 past 10. Thank you very much. Hi, everyone. I hope everyone is back. We are going to be starting again with the second half of the presentation. And for this, I'm very pleased to welcome Matshidiso Malgas, who's going to take us through the next bit about product suppliers. Chidi, thank you very much for joining us, and over to you.
Thank you, Charene. Good morning, everyone. Thank you for joining us for this workshop this morning. My name is Matshidiso Malgas. I'll be taking you through the following sections on our presentation, that is section 4 of the General Code to section 9 of the General Code. So the first section that I'll be taking you on is section 4, which is about information on product suppliers, which is part 3 of the General Code of Conduct. So section 4 of the General Code is applicable to providers other than direct marketers. And what section 4 requires that providers must furnish clients with information about the relevant product suppliers that they are dealing with. And where such information was given orally, such information must be confirmed with the client within 30 days after the information was provided. So the relevant information on which the provider must furnish to the client regarding product suppliers, it's information such as names, physical location, telephone numbers, and business addresses of the product suppliers. Also, the contractual relationship which the provider has with the product suppliers, if there are any, and whether the provider has any contractual relationship with any other product suppliers. So if there are any conditions attached or restrictions imposed by the product supplier with regards to the type of financial products or services that may be provided or rendered by the provider, such information must also be provided to the client. And then the requirements as contained in section 1410 relating to comparisons in advertising also apply here. Martha, my colleague, will take you through this in detail. Will take you through section 14 in detail. So also, a provider may not, when dealing with client, compare different financial products or different financial suppliers. That is, a provider may not compare different product when dealing with a client. A provider must compare apples with apples and not compare different financial products which are not similar in nature. So in this manner, a provider may not make inaccurate, unfair, or unsubstantiated criticism of any financial products or product supplier or provider or representatives. And also information that needs to be disclosed to clients is whether the FSP holds more than 10% shares of the product supplier, or whether the FSP earns more than 30% commission or income from the product supplier. And then the next section is section 5, that is information on providers. So in this section, section of the General Code, the requirements are applicable to providers other than direct marketers that render financial services to clients. So what is required of the provider here is that the provider must provide the clients with full information, and where such information is provided orally, it must be provided to the client within 30 days. That it must be reduced down in writing. So the relevant information that must be provided here is the full business names and trade names of the provider and registration numbers of the provider, and the details of the representatives of the provider, and details concerning the compliance department, that is the name and contact details of the compliance department, details regarding the financial services which the provider is authorized to render, and whether there are any restrictions or conditions attached to the license of the provider. And also, the provider must provide the client with information whether the provider holds any guarantors, professional cover, or fidelity insurance. And also, the provider must provide the client with information whether any representatives of the provider is rendering services under supervision. This is very important, especially in terms of the determination of fit and proper requirements. So the provider must also disclose to the client whether there are any exemptions or restrictions which have been exempted, but which has been exempted by the authority or has been granted to the provider in terms of the general code. And then Section 6 of the General Code deals with contacting of clients. So in this section, there are two occasions that the General Code make mention of in terms of contacting a client. So a provider must, when making contact arrangements in all communications and when dealing with a client, they must act honorable, professionally, and with due regard to the convenience of the client. So all arrangements to communication with the clients, the provider must have due regard to the convenience of the client. And the second requirement is that at the commencement of any contact, the provider must explain the purpose of the contact to the client, and at the earliest opportunity, provide the information relevant in terms of Section 5 of the General Code, such as information regarding the provider. Okay, and then the following section is Section 7 of the General Code, which is Part 6. And this section deals with information about the financial services. So the section is applicable to all FSPs, including direct marketers. So the requirements here are that a provider must provide a reasonable and appropriate general explanation of the nature and material terms of the relevant contract or transactions to the client, and must disclose in full the details to the clients about the marital obligations, and must disclose the details of services rendered by the FSP or representatives, and must also inform the clients about their rights. And the FSP is also required to provide information to the client in writing. So this information, again, if it was provided orally, must be provided to the client in writing within 30 days. Next slide, Tandi. So Section 7A was inserted by Board Notice 706 of 2020. In Section 7A, it gives requirements where there are forecast, illustrations, hypothetical data on projections on benefits and past performance. So this section applies to advertisements and when rendering a financial service and the provisions on statements about past performance, forecast, illustrations, and hypothetical data or projected benefits. And then Section 8 deals with the suitability when furnishing advice to clients. And this section applies to all FSPs, including direct marketers. So Section 8 establishes a client financial, so Section 8, so prior to providing a client with advice, a provider must take reasonable steps to seek the client appropriate and available information regarding the client's financial situation, financial product experience, objectives, to enable the provider to provide the client with appropriate advice. So what this requires is that prior to the provider providing any financial advice to the client, the provider must take steps to ensure that the client understands the financial situation, that the provider understands the financial situation of the client, and that the client has the financial information and experience regarding the product that they are about to be rendered with, and that the client understands the objectives of the product that they're about to be sold by the provider. So where the client is a pension fund or medical scheme, a friendly society or employer of the entity, the provider must be in a position to identify collective needs and circumstances of members, employees, and other natural persons whom they will be providing those products concerning pension fund, medical schemes, and friendly society. So a provider must also make it clear to the client if the FSP, the FSP must make it clear to the client that the FSP, where the FSP is unable to identify a financial product that will suit the client, and suggest to the client contact another FSP or authorized FSP. That is where the provider is unable to assist the client in terms of a financial product that is suitable to the client. So further to this, in terms of conducting suitability analysis, the provider must conduct an analysis for the purposes of advice based on the information obtained, and identify the financial product or products that will be appropriate to the client's risk profile, financial needs, subject to the limitations imposed on the provider under the Act or any contractual arrangements. So also, where a provider is conducting suitability analysis, the financial products, for example, where the financial product is a replacement product, the provider is to replace an existing financial product, whether wholly or partially, held by the client. The provider must fully disclose to the client the actual and potential financial implications, costs and consequences of such a replacement, including, where applicable, full details of fees and charges in respect of the replacement product. So where a provider is providing a client with a replacement product to the one that the client is holding, such information must be disclosed to the client, such as fees and charges of the replacement product, and must be compared to those in respect of the terminated product. And the client must understand this information, that whether there are fees or charges to terminate the existing product. Also, the client must be made aware of any special terms or conditions, exclusions of liability, whether there are any waiting periods or penalties or excesses or restrictions on the terminated product when acquiring a replacement product. And those must be compared to those applicable to the terminated product. Next slide, Tandi. Tandi? Okay. Okay. Yes, I've indicated in terms of replacement product, full disclosure needs to be made regarding the financial implications, costs, and consequences of a replacement product. And the clients must take the clients through the information into account, whether the client is refusing to provide information as requested. Then the provider needs to alert the client of the limitations on the analysis. And if the client does not allow, and if the client does not follow or follow recommendation, inform the client of possible risks they face as a result of their action. So where a client is requesting for a replacement product and they are not providing enough information for the provider to make a substantiated disclosure, then the provider then can make a recommendation to the client and inform the client of the possible risk that they face for their non-disclosure. Next slide. And then section 9 of the General Code is a record of advice where a provider has provided advice to the client, and now the provider needs to provide the client with a record of advice as was provided. So the provider here must, subject to, in addition to duties imposed by the Act, maintain a record of advice which must be furnished to the client. So this record of advice must provide a brief summary of the information and material on which the advice was based, and the financial products which were considered. Must also provide information on the financial products and products recommended with an explanation of why the products or products were selected or are likely to satisfy the client's identified needs and objectives. And also information that must be provided include information where the financial product or products recommended, the replacement product. Must also provide, again, the comparison on fees, charges, on special terms and conditions, whether there were any exclusions of liability, waiting periods, or penalties. Also, the record of advice must include information on the reasons why the replacement product was considered to be more suitable to the client, needs, other than retaining or modifying the terminated product. And the client, it is important that the client be provided with a copy of the record of advice in writing. Thank you, Thandi. Next slide. Okay, and that brings me to the end of my presentation, and the floor is open for questions.
Thank you, Matshidiso, for a very interesting and illuminating discussion. We are happy to, Thandi, I see you've got your hand up, so please go ahead.
Hi, Charene. Oh, sorry. Sorry for cutting you. I just wanted to highlight that there's someone who asked a question, who asked that we go into detail on section 7, capital A, on the forecasting illustrations, hypothetical data, as well as projected benefits of past performance. Shall I go back to the slide?
I think so, yes, please.
Thandi.
Okay.
Please
Yeah.
go back to that slide.
All right, so so it was very light there, but I know it is a bit bigger than that. So if we can just give them a bit more detail on that.
Okay. Okay, so section 7A, as I indicated, was inserted by Board Notice 706 of 2020. And what section 7A requires is that the requirements that are contained in section 7A, the requirements in this section will also be relate to those requirements as contained in section 1415 of the General Code in terms of marketing. So a provider in this case may only make statements regarding past performance, awards, rankings of a financial product or financial service if the basis on which the information is measured is clearly stated and the presentation of the performance is accurate, fair, and reasonable. So where a provider is providing is making statement regarding past performance of any financial product, including rewards or rankings of a financial product or financial service, that information must be based on past performance that is clearly measured, it's clearly stated, and where the presentation of the performance is accurate and fair and reasonable. So the statement made by the provider must be accompanied by warnings of past performance and must not be indicative of future performance. So statements about past performance provided by a provider must not be an indication of past performance, where past performance is relevant to the financial service being rendered. That is when the statements about past performance are relevant to the financial services being rendered. So a provider here that uses forecasts, illustrations, data, or other projections when rendering financial service must furnish the client with support for such forecast, data, or projections in the form of basic assumptions, including but not limited to relevant assumptions, performances, return, cost, and charges with a reasonable prospect of being met under current circumstances. So a provider must make it clear that they cannot guarantee or are not provided for illustrative purposes. So must disclose whether returns or benefits are dependent on past performance of the underlying assets or other market factors, clear indications, and give clear indications of such dependencies, and must warn the client about risk involved in buying or selling financial product based on forecasts, illustrations, data, or projections. Thank you.
Thank you, Matshidiso. And I think bottom line is the client must understand exactly what they're going to get out of this investment should they decide to invest in a specific product or take out a specific policy product. You have to understand where there are guarantees and where there are no guarantees. You mustn't be given a false impression, because we know that sometimes the markets are volatile. Johan, I see you have your hand up, and then Anton. So please, Johan, go ahead.
Thank you. Can you hear me?
Yes, we can.
Okay, thank you. My question relates to the replacement of financial products. I think the code is quite clear in terms of what needs to be done and how it needs to be done when you're replacing one financial product with another. But where the code has got a bit of a gray area, in my opinion, is how do you define a financial product under this replacement concept? Let me explain what I mean. You could end up with a situation where you look at the client's overall portfolio, and from an affordability point of view, and from a balance point of view, you need to advise the client, listen, you need to surrender this savings product that you've got because you are critically short on your short-term cover, for instance. Now, both are financial products, and the advice is that you actually need to replace a savings product with a short-term insurance policy. Where and how do you draw the line between when is it a replacement of a financial product because it's two unrelated products, but it is related in terms of the client's portfolio? Can you expand a little bit more in terms of how do you define when it is a replacement in terms of the different types of products that you've got?
So, Johanna, I think you've actually answered in your question, but it's a really good question. So you were taking a portfolio approach to your client situation. So in this portfolio approach, you said overall, you are underextended in terms of your short-term insurance products. You're not covered for all of the eventualities that you are facing, and the only way that you can afford to change that is by giving up all or some of your savings account money. And instead of putting X amount into your savings, make it X light and use the difference to invest on your short-term insurance side. So I know I'm using the word investment very broadly here. It is rather just allocate some of that money to your short-term side so that you don't have a gap there. And in that, you are giving advice that is directly affecting a part of the portfolio, that is the savings portfolio, so that the person can also afford to cover the need on a short-term side. Although it is not an apple for apple replacement, it is still a decision in terms of the overall financial portfolio, and I would record that.
Thank you. Thanks for clearing that up.
Pleasure. Then Anton, please go ahead.
Good morning, Charene. Thank you. My question relates to the record of advice. Now, Section 9 is very clear as presented of the record of advice title, but there seems to be a misalignment from the previous Ombud around the interpretation of what a record of advice is. They played it that a record of advice is one singular document, whereas the Financial Services Tribunal recently in the past year or two have found that they agree with the notion that a record of advice doesn't necessarily consist of one singular document. They hold the view that a record of advice can consist out of a number of records that indicates what transpired between advisor and client. Charene, I may have missed the FSCA's official position on this issue, and if so, I apologize. But I would really like you just to provide us with some clarity on what the FSCA's view is in view of the differences of interpretation from the Ombud's Office of in the past and the Financial Services Tribunal view.
So, Anton, we cannot comment on the Ombud's Office determinations. They are an independent body from us. We do look obviously at what the Ombud has determined, and we've also taken a close look at what the Tribunal has decided. So the view of the FSCA, and it's an informal view, we haven't formalized this anywhere, but if you look realistically at the relationship between a client and their advisor, and this relationship comes over a period of years, often the record of advice is not one document. So there might be one document pertaining to a specific transaction, but where the client has entrusted a portfolio to a specific financial advisor, you will find that the record of advice is made up of bits and pieces of conversation. And Matshidiso, you also work with very large organizations where they have clients with a number of different products that they assist the client with. I think you would have also found in your experience that the client's record of advice actually becomes quite a thick document. Some of it may be very formal, and some of it could be an email, or even nowadays a WhatsApp conversation between the client and the advisor. All of this culminates in a record of advice. It's very seldom just one document. But Matshidiso, I would be happy for you to also add in here.
That is correct, Charene. A record of advice in most cases cannot be just one document, because providers meet with clients on a regular basis. So discussions are held on a regular basis where a client may require advice on different products, or when a client may require a change on the existing financial product that they have. So advice is rendered in those circumstances, and must, each and every time that a client requires advice, must be recorded and must be in writing and provided to the client.
Thank you very much.
Thank you very much. Anton, have we answered your question?
Yes, indeed. Thank you, ladies. That was very clear. I appreciate it.
It's a pleasure. Then Wendy and then Lena. Please go ahead, Wendy. Wendy Gibson, you can unmute your microphone. Okay, it looks as if we might have a technical challenge with Wendy, so I'm going to go to the next person. Lena Hewitt, we're going to give you microphone access just now. Lena, you can go ahead.
Hi. Thank you. I just wanted to ask, Matshidiso, in terms of the exemption, so in instances where there hasn't been an exemption provided by the FSCA to the provider, does lack of or an instance where the document is mum, it doesn't say anything whether there has been an exemption or not, acceptable, where there isn't an exemption that has been provided by the regulator.
Okay, thank you, Lina, for that question. Where there's no exemption provided, there would not be any reason to disclose any exemption because there's none that was provided by the authority. So a provider will disclose an exemption that where there's an existing exemption that is granted by the authority.
All right. Okay. Then I have another question on the record of advice. So as let's say a scenario where you have a broker that's providing advice for the or to the customer, but the product suppliers are various. So you have more than one product suppliers that are noted on the ROA. What would be the best way for a supplier to kind of practice oversight in terms of their product if then the broker or the advisor says that they can't share the ROA because they have multiple product suppliers on that ROA?
Okay, Lina, the general code is clear that a provider must disclose the product suppliers that they are dealing with, whether it's a single product supplier or multiple product suppliers. So I don't think a provider has a right to say to the client that they are not able to disclose because of multiple product suppliers that they have on a particular single product. So they are required to disclose to the client the various product suppliers, and where they have made comparison of products for the different product suppliers, they must disclose that to the client as well.
So how?
I'm not sure if I answered your question.
So how do you then practice oversight as a product supplier in terms of the advice that was provided to the customer?
You mean the product supplier or the provider?
The product supplier.
So in this case, you're referring to a case where a client is dealing with a product supplier and not the provider.
So half the time you will have like a 3-story. So it's a client is the provider and the supplier. So the supplier doesn't provide advice or sell the product. So the product provider is the one that's selling the product, right? In this case. And you need to provide oversight in terms of ensuring that the advice that was rendered or was provided to the customer is suitable.
Matshidiso, can I come in here?
Okay, all right, Charene, thanks.
Thanks. Lina, I think this is an interesting conversation that you're having. Remember, the legislation imposes the obligation of oversight on the FSP. So this is the financial advisor. So if there is a representative working for the FSP that gave advice to the client, it is the FSP that has the oversight responsibility, not the product provider. So the product provider has a due diligence obligation when they take on an FSP to give advice and render intermediary services on their products towards clients. So that due diligence at the start, and there could be arrangements for ongoing due diligence, but that would be on the FSP because the legislation places the obligation for oversight of the representatives on the FSP. So there could be a contractual agreement where the FSP allows the product supplier to access. But again, you've got to be really careful here because you do have both our Section 3.3 of the General Code that was alluded to earlier, where we have very strict provisions about what information can be shared with a third party. And in this instance, from an advice perspective, the product supplier is actually a third party. You also have POPIA obligations now where you have to keep information really private. So I would suggest that this is not just an easy conversation and it requires quite a bit of thinking. But the product provider has no automatic obligation in terms of overseeing the advice given by the external FSP. Does that help you, Lena?
A little bit. So I think for me, I'm covered with the product provider. So my bugbear is actually the product supplier.
Okay, so Lena, can I ask you that I don't think we're going to solve that problem in this discussion. It sounds as if it's a very specific situation. Would you like to contact us, give us your contact details, and we can contact you separately and see if we can assist you offline?
All right, thank you so much.
Pleasure. And then we have Byron, and then we're going to try Wendy Gibson again. So Byron, you're going to get mic access now. There you are. Byron, you can unmute and go ahead, and then we're going to try and see if we can connect with Wendy.
Perfect. Thanks, Charene. Can you hear me?
Yes, we can.
Okay, so I have two questions which relate to the replacement advice record. So just building on the previous question that was asked. So in that instance, it was replacing one product with another, even though they were related in some shape or form. However, what happens in the instance where a customer has a shortfall or a client has a shortfall, let's say with gap cover, and there's been a suggestion that's been made that a client cancels one of the funeral cover products because they're overinsured, or it's over maximum or something to that effect, but there's effectively no link between the one product being cancelled and the other one being implemented. And there's a few other instances of that, like in the personal life cover space, where someone is overinsured, or from a financial needs analysis perspective, they're overinsured, but they need to increase their investment amount. So the one wouldn't effectively replace the other. Would this be as simple as noting it on a record of advice, but not necessarily needing to complete a RAR form? And then the other question is specifically related to the process when replacing products. So I can't remember which board notice it was, if it was a board notice, but I think it was in 2017 or 2018. And I just want to know, where does the duty lie? So I understand that from a replacement point of view, the representative and the FSP has an obligation to understand the financial needs of the client and what the client needs, but there was something very specific about if a product is replaced, the insurer or the product supplier was given, I think it was 14 days for the document to be sent to them for a department therein to review it. And in the event that the advice that was given was contrary to the needs of the client, for the product supplier to then to reach out to say, listen here, this needs to be revoked or reversed. Yeah, those are my two questions.
Thank you very much. Chidi, are you comfortable to go ahead?
Yes, Charene. So when replacing a product with another one, I think what is important here is making sure that you gather as much information as possible regarding the specific needs of the client. So in this, when you're replacing a product, the client should be placed in a position where the client is able to make an informed decision regarding the product that they're replacing, and that the client needs to understand the full implications of the replacement product. So if you're replacing a product with another one, you need to acquire the necessary information about the product that you are replacing. So moving one product to another, a client needs to understand the implications of replacing one product with another. And the clients, they need to be explained whether there's any fees, costs, or implications of replacing one product with another, and whether there's any for example, a product is replaced and there are cancellation penalties. Such needs to be explained to the client, and the client needs to understand that the penalties and costs implicated with replacing one product with another. And those need to be reduced in writing as well and be provided to the client. Such record of advice must be provided to the client as well.
Perfect. Can I just jump in here quickly? So it sounds, and my understanding was always that replacement was in the first instance drafted around the investment in the life space, where like you stating that there could be penalty fees and or new fees being drafted. But for example, in the medical aid space, where there's a forced new product that's needed. So, for example, a minor is on their parents' medical aid. They're no longer dependent on their parents, and they need to go on their own medical aid because, from a cost point of view, it's in their best interest. Well, it's financially cheaper for them to go onto their own policy instead of them being a dependent. Would that, strictly speaking, be seen as a replacement? And then also, if someone goes from the employment of an employer-employee relationship to private capacity, technically they have to change because they no longer benefited from a group scheme. And would that be noted as a replacement, or would it be as simple to show the client? So note, yes, this is a replacement, but show the client, okay, this is the medical aid you were on, this is what you were covered for, and now this is what you're covered for. What are your guys' views on that?
Okay, so the first scenario where a student is leaving the parents' medical aid and taking their own medical aid, that should not be considered as a replacement product, because in that case, the student, the medical aid, they were not responsible for the medical aid, but the parents were responsible for the medical aid. So they were just a dependent on the medical aid. And then in the second scenario where a person is changing employee and moving from one medical aid to another, that is a replacement product. And the requirements in terms of replacement product, again, needs to be explained to the employee by the relevant advisor in the employee in the company where the employee is. So again, the requirements of the replacement product in terms of the general code must be explained to the client, to the employee. Thank you.
Perfect. Thank you. I understand.
Thank you. And Byron, just on your last part of the question that you asked about the prescribed format for the replacement advice record and the timelines for submitting that. So that is actually prescribed in terms of Rule 19 of the Policyholder Protection Rules under the insurance legislation. And it pertains to very specific long-term insurance products only. So if you go and read Rule 19 and the documentation that was published with it, you will find it's referred to as the RPAR, the Replacement Product Advice Record, and the guidelines under the insurance legislation. If you can't find it, pop us a note in the chat function. We'll find it and we'll let you have the link. Thank you.
That's perfect. Thank you.
Excellent. Then, Wendy, let's try and see if we can get you to ask your question. Wendy Gibson? Okay. Wendy, it looks as if we have a technical glitch with you as well. Could you please type your question in the chat function and we'll make sure to answer you. Then, as there are no hands up, let's just take a 5-minute leg stretch. My clock says it's 10:49. So if we could start at 10:55 again, and Martha Swarts is going to take us through the last section. Thank you very much for your presentation, Matshidiso.
Thank you.
Hi, everyone. I hope that you're all back from your leg stretch. We are going to start with the last session of this morning, and I'm really pleased to welcome Martha Swarts as our specialist presenting on this section. Martha, I see you've got the slides up, so thank you very much, and over to you.
Thank you, Charene, and good morning, everyone. Like Charene mentioned, I'm Martha Swarts, and I will be taking you through custody of financial products and funds, risk management, advertising, direct marketing, complaints, engagements with ombuds, and termination or agreement of business. I'd like to highlight that this section of, going back to the custody of financial products and funds, is a very important section because it directly affects the customer on the client, and non-compliance thereof really hits the pockets of the client. As also as the authority, we have seen FSPs that misappropriate and client funds. So it's one section of the code where it impacts directly in respect of monetary value when it comes to the client. Now when it comes to custody of financial products and assets, the code requires that if cash is received, the FSP needs to give the client a receipt. This is quite important, as we all know that receipts are an important source of evidence that the client has paid for the financial services rendered. The FSP is also required to open a separate account for client funds if the FSP holds client funds. There should be an account for operations of the FSP's business, and also separate bank account for client funds. And then I think most FSPs might have noted during the application process that you are required to complete the banking details of the FSP. And one would be for for the FSP's operational business, and then also separate bank account if you hold client funds. And I'd like to bring to the attention of the FSP that should it happen during the course of business that FSP stops holding client funds, or they change to actually receive or hold client funds, they need to submit a profile change to either add or remove the bank account. And then the requirement also says that the FSPs do not pay the administration costs of the account from that separate bank account. So it's also that illustration that client funds and FSP's funds should be dealt with separately. And then when it comes to keeping client funds and also assets, they should be FSP should be kept separate from the FSP's funds and assets, as I alluded to. Regarding the client mandates, also we know we have especially for K2s where they have client mandates. They have the responsibility to adhere to the mandates that they have signed with the client. So that would tell how the funds of the client should be dealt with. So this is also important when it comes to custody of client funds. And then when it comes to operating a separate bank account, there's a requirement of Section 10(1)(d) that says there should be a separate bank account. But please note that this does not apply for those FSPs that deals with premiums they'll hold on behalf of a short-term insurer or a long-term insurer. So, and the condition to this is that it only applies if the provider complies with those sanctions of the Short-Term Insurance Act and the Long-Term Insurance Act. Now, when we come to actually the findings as the regulator, the trends that we've picked up when it comes to compliance with holding client funds and client monies, we found that FSPs that do not hold client funds, that hold client funds, do not have separate bank accounts, and the client funds are actually mingled with the FSP's operational account. So it's something to look into, that FSP are actually compliant in this instance. We as the authority, we've also found that there's no, like I mentioned previously, when you stop holding client funds or holding client monies, when you start holding client monies, there should be a notification to the authority regarding this instance. Like, for instance, when we do inspections, we find that this is really not adhered to. We normally request banking details during when we conduct inspections, and we found the information is really contradicting what we have in on records. So we urge entities to submit the necessary profile changes when it comes to bank accounts of the FSP. The other thing is also when it comes to client funds, which is quite scary because, like I mentioned, this is where the client is impacted directly when it comes, to the money side of things. Is that we found that there are FSPs that hold client funds and that did not pay over the premiums on time, or to the polish. They're not they're not pay over the premiums or to the provider on time, meaning that the customers might not be covered should it happen that there's a claim, and this can result in really an unpaid claim. This would be prejudice to the client and also cause inconvenience to the client when they really need the money for their personal circumstances. And we also found that when it comes to client, Cat 2s or Cat 2As, where there are client mandates are actually not adhered to, you find that your asset managers, they would invest client funds in risky investment or not according to the mandate, where mandates are breached. So this is quite important section of the code that the FSPs need to keep in mind when dealing with client funds. Next slide, please. It hasn't moved yet, Thandiwe. Thank you. So now we need to, it's supposed to be risk management.
Martha, it might just be slow on your side because I could see the slide. Thandiwe, there we are.
Yes, I can see it. I can see it, Charene. Thank you. Now moving to risk management, as to any kind of business, risk management is quite crucial to every entity. And then the requirement is that the FSPs need to employ effective resources and systems to minimize the risk of financial loss through theft, through fraud and other dishonest acts, or poor administration, negligence, professional misconduct, or culpable omissions. So that is the purpose of the risk management, to reduce the risk within the entity that might cause any harm to the business in respect of finances, administration, theft, fraud or dishonest acts, but also the employees of the FSPs. Now, when it comes to internal procedures of the RMCP risk management, all internal control procedures, they help the FSP to carry on a business orderly and efficiently, to give reliable information and other information, and also to ensure that entity complies with all applicable laws. This is quite crucial for the entities to consider, because when drafting a risk management plan, you also need to take into account the different legislation that are applicable to. I think the most popular one, like currently, is POPIA, and also figure that needs to be considered when compiling a risk management plan. And also, the other important aspect of risk management is always to identify new emerging risks to protect your business. And this will be helpful to the FSP to actually pick up the risk issues that might be pertaining to the entity. Currently, the talk, the risk that is quite major in the industry that we've come across is actually the cyber risk. I think we've seen on the news, that there have been cyber attacks in South Africa. Now we've also experienced, as the FSCA, that some of our regulated entities have experienced cyber attacks also. And this actually has an impact on the client's information. So there could be leaks of client information, which obviously pertains to confidentiality and to POPI Act. And then the FSPs need to put mitigate controls in place to mitigate for example, the cyber risk by having a cyber insurance. So that would also talk to the risk management plan in place, at the risk assessment that's being done by the entity, and controls in place. Now, when it comes to the findings and trends that we have picked up as the regulator, is that we find that there are no risk management plans, especially when it comes to small entities. And then where there are risk management that are in place, we found that templates used, maybe they've been provided from the compliance officer. And then these templates are not actually adapted or specific to the FSP's nature of business. And also what we've come across is that the RNP might be in place, but it's not adequately documented. Like, for example, there might be risks that have not been considered by the FSP. So these are, those are the things that we look at when we conduct inspection. And I think the most important one is that also we found that there might be a risk management in place. It might be adequately documented, but it's not implemented. So there's no point of having a document as a tick box exercise, but not implementing it. I think as the authority, when we do inspections also, we would like to see the implementation of the documents in place and not just being done as a tick box exercise, as I mentioned. Next slide, please. Thank you. Now moving to advertising, which is section 14 and 15. I think FSPs need to take cognizant that there is huge, extensive changes in respect of advertising from the current code of conduct to the previous conducts. So when it comes to advertising, the code indicates that the purpose of this section of the code is that the client includes general public. So most of people might know that, when it comes to the definition of clients, most of the time in terms of FAIS is quite different from this one. So when it comes to advertising, the client here means the general public. There are general principles to adopt in terms of the code. Where feasible, measures must provide an objective review of an advert other than by the person prepared or designed it. So this requires a secondary review. So we need to see that there's an objective review in terms of the advert. And also one thing, I think it's a most common principle that, an advert should be factually correct. balanced and not misleading. So the code provides guidelines also in these instances. And also regarding the public interest, it's addressed in the code. And the code requires that the advert should identify the product supplier or the provider. So there are also requirements in that instance. The requirement is that also the code, the advert should use appropriate language and medium, and there should also be record keeping of adverts that are kept by the FSP. So whenever the entity has advertisement that has gone out in the public, there should be record keeping of this. And I think generally when it comes to record keeping is to provide that audit trail, that to ensure that we as the regulator and also other people, external parties, can actually see what was done in respect of advertisements. So record keeping is also important in that. And then the code also refers that no negative opinion marketing is allowed. And also there is also no unwarranted direct marketing. So this refers to where a product or any person acting on its behalf uses a telephone, mobile, phone call, voice or text message other than electronic communication for an advert. So that is unwarranted direct advertising. I think most of us, we really don't like it where we get people who call us without knowing, where they get their numbers, where they sell the products to us. So that is also highlighted in the code, that what is required when it comes to unwanted direct advertising. The other thing that the code refers to is about comparative marketing. There is no comparative marketing that is allowed, and the highlights also that are highlighted in the code. And then the code refers to puffery. So puffery means any value judgment or subjective assessment of quality based solely on the opinion of the evaluator, or where there is no pre-established measure or standard. This is one of the new terms also that are included in the code regarding advertising. So we need to take care of to be aware of the new definitions when it comes to advertising. It also relates to, when it comes to advertising, there also addresses endorsements, loyalty benefits, prominence, and also principles relating to illustrations, hypothetical data, or projected benefits and past prominence data. In essence, when you look into the whole requirements of advertising, the advert should not mislead the client or give information that is not factual. And actually, when it comes, we cannot give information that is quite unrealistic. We've seen a lot of, when it comes to investments, we've seen a lot of pyramid schemes. We've seen a lot of forex traders where they promise really unrealistic returns on investment. So this is what actually refers to when it comes to advertising. Those are the principles that should be adhered to when the FSP has advertisements. Thank you. Next slide, please, Tandy. Now moving to direct marketing. Now moving to direct marketing, my colleague Thandi mentioned that actually direct marketing means the rendering of financial services by way of telephone, internet, digital platform. Sorry, I keep getting this invitation into I can't see the slide. Thank you. So it means that rendering financial of services by way of telephone, internet, digital application, platform, media insert, direct or electronic mail, but excludes the publication of an advertisement. Now, when it comes to direct marketing, the FSP must do the following. I think for most people would know direct marketing, where mostly it is done by the call center, where the FSP will have a call center. In this instance, it is required that the FSP must record all telephone conversations in the course of direct marketing. That is quite important. And what's most important is that these recording must be stored and also be retrievable. The FSP must also provide that the client information in writing when the information is requested also. And most importantly is that when it comes to the requirements of the client has the right to request the recordings that they've had discussions on with the FSP, and that these recordings must be made available to the client. Now, the trend that we've picked up as the FSCA, and which is really concerning, is when it comes to direct marketers, also we would come across the irregularity report, or when doing inspection, that there are actually no recordings that are kept by direct marketers. And also the other thing that we've picked up is that we find sometimes there's a damage to the recordings, and the recordings cannot be retrievable. So it is important for direct marketers to actually take into account these, requirements and ensure that they are kept in place also. Thank you. Next slide, please. Now, moving to complaints, I think one should really note that there are quite extensive changes when it comes to complaint management. There are new definitions that are included in this, the amended code of conduct. The first one being client query, the second one being complainant, definition of a complaint. There's also a definition of compensation management, goodwill payment, member, rejected, reportable complaint, upheld. Now, going to the definition of complaint, you might have noted that there's a huge change in the definition. Previously, the definition was that a complaint means as completed as defined in section 1.1 of the Act, excluding the reference to section 26, submitted by a client to a provider for purpose of resolution by the provider. I mean, previously that was a 3-sentence definition, but now when you go into the code, you really see that the definition has been expanded, and it means actually that an expression of dissatisfaction by a person to a provider, or the knowledge of a provider to the provider service supplier relating to a financial product or financial service provided or offered by the provider, which indicates or alleges, regardless of whether such expression or dissatisfaction is submitted together with or in relation to a client query. Remember, we mentioned that there's a definition of client query, so we need to look at that. Now the complaint that relates to whether to a provider or its service supplier has contravened or failed to comply with an agreement, a law, a rule, or a code of conduct, which is binding on the provider or to which it subscribes. The complaint also might be related to a provider or its service supplier's maladministration or willful or negligent action or failure to act, and has caused the person harm, prejudice, distress, or substantial inconvenience, or the provider or its service supplier has treated the person unfairly. And so when you look at the definition, really, it's quite detailed, and we know the FSPs need to be familiar with the definition of the complaint. Now, we have previously conducted inspections and analyzed all compliance reports. That was last submitted in 2018, where the FSPs would indicate that they do not have complaints in place. Now, looking at the above definition of complaint, it's quite important that you take what definition of the complaint it's, so that you know that you're not there's not an oversight of what should be recorded as a complaint and what it should not. Thank you, Thandi. Next slide, please. Now, moving to complaints risk management framework. Now, I think this also is a requirement that's being included in the code, and it requires that FSPs to establish a complaints management framework, which is the CMF. So it also indicates the requirements of the CMF and also allocation of responsibility. I think that's the one thing we've seen, like I mentioned, a huge change in the complaint sector. And what's important, the requirement of categorization of complaints. For example, after you've identified what a complaint is, you need to put them into categories to say what kind of complaint I have received from clients. It would be complaint relating to the design of the financial product, the premiums or other charges related to financial product, and also the complaints relating to advice, complaints relating to financial products or financial service performance, and complaints relating to financial product accessibility or switches, including complaints relating to redemptions of investments, and also complaints relating to insurance risk claims, including non-payment of claims. So from this instance, we can see, what kinds of complaints that needs to be looked into. And also, when we're doing inspections as the regulator, when look at the complaints register, we want to be able to see this categorizations of complaints. It will actually give a good trend analysis to see what kind of complaints that the FSPs are having. And also from the FSP side, they'll be able to see, okay, which kind of area they need to improve on and to work on to ensure that, less complaints are received from clients relating to specific category of claims. And then the code of conduct also explains complaints escalation and review process requirements, decisions relating to complaints, and also record keeping, monitoring, and analysis of complaints. And like I mentioned, record keeping is quite important. Record keeping of complaints register also is important, and how the register should be kept is also important. Now, the code also indicates the communication with complainants. Also, that how should the communication be with the complainants? Now closing off on complaints. I think as the regulator, as a market conduct regulator, complaints handling controls and monitoring are quite critical conduct indicator and a risk tool, and it's also part of one of the TCF principles. So I think even you can notice on the amendments made that a huge part of the of the changes are pertaining to complaints. Complaints are so important as the regulator to also ensure are in place that if they've also been addressed in the Omni-CBR, the draft Omni-CBR that has been communicated to the entity, to the FSPs. It has its own separate sheet, where we'll be asking questions around complaints. So it's important for FSPs to take care, to note these changes also. Thanks. Thandi, next slide, please. Now moving to engagement with Ombud and reporting. This is also something that the FSPs must take off. It says that the FSP must be able to communicate with any relevant Ombud. Now, what Ombuds are there? There's the FAIS Ombud, there's the long-term insurance Ombud, short-term insurance Ombud. So the entity is required to be able to communicate with all these relevant ombuds. And also they must also make information available to the ombuds, maintain records therein. And also there's the highlights that the FSPs must monitor determinations, the publications and guidance issued by Ombud to identify failing risks, failings or risk in own policies, procedures, and practices. I think for other entities, complaints, it's not only relating to FAIS. I think, as the code says, it should look at engagement with other ombuds also that are applicable to the business of the FSPs. And then the code indicates that the FSPs must try to resolve complaints before final determination or ruling by the Ombud. So this is quite important to take note of. And one thing I like to highlight, that it's important that, to encourage your clients to, when it comes to dissatisfaction of any service, to try and resolve the issue with the clients before actually they come to the regulator or the case goes to the Ombud, to resolve the issues with the complainant before it goes into other external parties also. Next slide, please. Now, section 19 refers to reporting complaints. Now, this highlights that a provider must have appropriate processes in place to ensure compliance with any prescribed requirements, to be able to report complaints to any relevant authority or public as required by the authority. So this is another requirement when it comes to complaints also, that there must be processes in place to be able to report to the authority or public as required by us. Next slide, please. Now moving to termination of agreement or business, which is section 20. It should be read together with section 3, subsection 2 and 3 of the code. And I think Thandi spoke to it, but it relates to confidentiality of the client. The FSP needs to get client's consent before disclosing any of its confidential information. And then also when take action when the client terminates any relationship. Now, this requirement is applicable when the following ceases to operate: when the FSP ceases to operate, when the FSP representative ceases to render financial services. The provider must notify all affected clients and also take reasonable steps to conclude any business, transfer to another provider, and also the representative is also required to do the same. Now, I think one of the big talks in the organization or in the FSCA when it comes to FSP, and also I think it's also one of the big talks in the industry referring to back transfers. I'd like to highlight that we have received a number of queries regarding bulk transfers, and also we have received exemption applications around bulk transfers also. And I'd like to highlight that as the FSCA, we do not approve of such a practice. Once you do a bulk transfer, it means that you have not complied with section 3.2 of the code, which is client consent. And also when you think about it, you're also disclosing client information, which is a contravention of POPI Act, section 11.1, subsection, A. Also because you provide the information from your FSP to another FSP, which is not known to the client. So client consent should be received from the client in this instance, and non-compliance thereof, non-adherence thereof to that is actually non-compliance with the code of conduct. And I like to give also another scenarios we've come across is that some, when it comes to bulk transfer, the other example is the information sharing. When the business move from one FSPs within the same group of FSPs, the FSPs will argue, but we're moving from an FSP within the group, so we can, we request that the bulk transfer be done in this instance because the clients are known to us. But FSPs need to take into account that from our side as the regulator, we do not see it as that we authorize the FSP, which is the legal entity, and we do not take into account the group, relations. It's even the same when it comes to, I'll give example of financial, when you analyze financial statements, we do not accept group consolidated financial statements. We want to look at the licensed entity itself. So the same principle applies when whether it's within a group, it's one aspect to another, then there shouldn't be, bulk transfer in this instance. And I think most FSPs not take into account that, remember, when you transfer business, there are no guarantees that the services will be the same, that the charges will be the same, that fees will be the same. So if you look at it from that aspect, you notice that actually the FSP is deciding on behalf of the client, and that might not be in the best interest of the client. So as the conduct regulator with the mandate to look after the best interest of the clients, we do not approve of such a practice. The client interest of the client information should be shared with the, consent should be obtained from the client. And I think that's it from my side. And in closing, I would like to highlight that just like any professional body, like your financial planners or accountant, we as the regulator have this code of conduct for financial service providers and representatives to ensure that we also, we always highlighted that we want to professionalize the industry. And this the kind of conduct we expect from the authorized financial providers and the representatives. And also it talks to how the FSP conducts itself towards clients and ensure that clients are not prejudiced. And then the code also ensures that clients being rendered financial services will be able to make informed decisions and that the reasonable financial needs regarding financial products will be appropriately and suitably satisfied. So it's really an urge that we want FSPs and representatives to act honestly, fairly, and with due skill, care, and diligence, and in the interest of clients and in the interest of the financial services industry. And as the mandate as the regulator, when we're doing our own desk-based supervision or during virtual or on-site inspections or engagement, we will be looking at compliance to looking at the compliance to the amendment of the General Code of Code. So we urge FSP to be familiar with the Code of Conduct and be able to know what the requirements are and what they need to adhere to. Thank you, Charene. I'll open the floor for questions.
Thank you very much, Martha. Just before we look at the questions, the General Code of Conduct, Akashan has posted a link to our website where if you click on the link, it will take you to the website. You can then click on the General Code in that link and you can then download the document and it gives you all of the amendments in one document. So for everyone who asked for us to email it to you, please just scroll up and you will find the link in the chat function. Then let's take a look at the hands, and we are going to give access to Charmaine now. So Charmaine, you have access. You can go ahead and ask your question.
Hi, morning, Charene. Yes, can you hear me?
Yes, we can.
Yes, we can hear you.
Wonderful. I posted my question in the comment section as well, but I haven't seen an answer. My question is relating to direct marketers. In terms of the very wide definition of a direct marketer, who is a provider who in the normal course of business provides all of the predominant part of the financial services via telephone, internet, etc. Do you regard a short-term insurance broker, a normal short-term insurance broker who basically deals via telephone and email with renewals and claims, etc.? So I would say about at least 70% of their business is via email and telephone. Do you regard them as a direct marketer?
Charmaine, it's a very interesting question. And in terms of the change of the definition, they would fall under the definition of a direct marketer if you look at it now. So I think that when the definition was changed, and especially with the change in our modus operandi as a result of COVID and the resulting lockdowns, many people who previously did not fall under the definition of direct marketer probably now does tick the boxes and they would fall under the definition of direct marketer. And sorry, Martha, I took away the response from you, but I can see from your smile that you agree.
Yes, Charene, definitely. And I think, like you mentioned, when you look at the definition directly from the Code of Conduct, it's quite explicit, like unlike previously, it refers to telephone, internet, digital application, media, insert direct or electronic email, but exclude advertisement. So I think it includes that also. Thank you.
Okay, wonderful. I agree. Thanks, guys.
It's a pleasure. Any other questions? Guys, we've booked until 12 o'clock. We've got to use up the time. Annette Davis, and then, okay, we have quite a few hands, so we're going to give feedback. Mic access to Annette first, then Nonschlanschla, and then Meyer Byron. So Annette, you can go ahead.
Good morning, can you hear me?
Yes, we can.
I have a question regarding direct marketing. Does it only refer to new potential clients, or does it even refer to your existing clients? So if I find my existing clients and want to sell to them short-term insurance policies, does these rules also apply to them?
Yes, it does, Annette. It does, because remember, like as per definition, it explained, when rendering financial services. So whether it's new clients or existing clients, this applies to the direct marketer also.
Thank you very much.
Thanks, Martha. Byron, you can go ahead.
Hey, ladies. Okay, so two-part question again. So the first one is relating to the complaints category. So just to set the scene, FSP has both an intermediary agreement as well as a non-mandated intermediary agreement with insurers. And the large majority of the business that's done by the FSP is execution of scripted sales in the short-term insurance space. So the relationship with the client is not similar to that of most financial service providers, where they would see a client face-to-face, or like the other person noted earlier, where there's communication via email, but there is normally a personal relationship there. So the large majority of the complaints come in the form of rejected claims, where the FSP is providing the NMI function or the binder function. So my question is specific to, would that be simply noted as for a 3, where it's just, sorry, 2, where it's complaints relating to information provided to the clients, or would it be as simple as just saying other? And then my second question relates to providing clients with the Ombud details. So when dealing with complaints, there will in the first instance be communication to a client to say, thank you, we've received your complaint, here's your reference number, this is the person that's going to be dealing with the complaint, and then putting the relevant Ombud details there. However, what we find is that instead of a client using the complaints management framework and the process, in a lot of the cases, they go to the Ombud or the relevant Ombud in the first instance, so short-term insurance Ombud, which sometimes frustrates the insurer, because I think insurers get given fines for every Ombud claim that goes to the Ombud. So how would you guys deal with that? Would you only provide the Ombud details, just bearing in mind that within fulfillment and policy wording and schedule, the Ombud details are all noted, but would you maybe provide the Ombud details at the end once you've gone through the entire complaints process internally, as well as escalation, or at escalation stage, or what would your train of thought be? Thank you.
Hi, Charene. Can I please take the Ombud one, and you can take the first one on the insurer. So when it comes to the Ombud detail, I think requirements, the code of conduct is quite straight. It shows the requirement. Now we do not in a way prescribe how the complaints process should be. Remember, the code would explain what we need to see. Now the FSP would have its own procedures and processes to ensure that the requirements are met, and obviously that best best practice principles are adhered to. So the details, I think it comes to the communication with that the FSP needs to have with its clients, the awareness, the training to say, it can either also be communication in terms of maybe newsletters, although to highlight the importance of engagement between the FSP and the client, and encourage them to follow different processes and engagement with the entity before going to actually the relevant ombuds. I think the onus is actually on the FSP engagement with the clients to raise awareness around complaints management and issue regular communication to make sure, how would the FSP like to conduct its complaints management process or framework.
Okay, perfect. That makes sense. Thank you.
Thank you very much, Martha. My apologies, Byron. Could you just repeat the section of the question that we haven't answered yet?
Sure. So it's just relating to the 11 categories of complaints, and the scenario is such that the large majority of complaints are for rejected claims. So my question is, would that just go under Roman numerals 9, the 9 categories? So Roman numerals 9, where it's other complaints, or would it fit into Roman numerals 2, where it's complaints relating to information provided to clients, but very specific for complaints that are as a result of a rejected claim?
So my inclination is to follow your second option. The reason for that is if you get a majority of your complaints are around repudiated or rejected claims, as a business, I would want to be able to track that. And I'm not going to have that level of detail if I record all of these just under other. Because if you have a large number of rejected or repudiated claims in your business, you would need to start analyzing what is the reason for this. Is this that your script does not provide sufficient information up front? Or is the policy wording perhaps not clear enough? So is it something that as an FSP you can change so that clients are better informed before they take up the policy? Or is it something that the product provider can change in their claims documentation that would give the client better information? But if you have a lot of repudiated claims, there surely should be a reason for this. And if you just record it under other, it's going to be quite difficult to track that.
That makes sense. Thank you very much.
Pleasure. We have Ian, Natasha, and Karen in that order. So Ian, you have mic access. Please go ahead.
Good morning, ladies. Can you guys hear me? Thank you very much. Just a quick question from my side, and a little bit of a gray area, I think, between the definition of advice and the definition of direct marketing in the POPI Act. To give you a practical example, and I don't know if my colleagues have also experienced this. Say, for argument's sake, I've got a client that wants advice from me, but specifically said they don't want marketing from me. Now we're in a situation, for argument's sake, one of our product providers has changed the wording, and there's now some exclusions or some benefits falling away with the new product. Now I've got to inform this client about the changes in the policy, but as an advisor, I also have a responsibility to advise this client that there's now an alternative that the client can consider to make up that gap that has now suddenly appeared. Now, is this advice or is this marketing? Thank you.
Thanks, Ian. Martha, do you want to answer? Martha, you muted.
Okay, I think if I understood the question correctly, so you want to change the details of the policy and inform the client. Now, in this instance, I would assume, marketing, direct marketing, sorry, I don't know whether you're referring to direct marketing or normal marketing, but direct marketing has a definition of its own. So it would depend how you've actually conducting your business. Is it client facing? Is it a direct marketer? It depends how you rendering financial services. Now, in this instance, I think you mentioned that this is the client of yours. So you would have the details of the client where you'll be able to contact them and inform them. I don't think, if I understood correctly, that you would also that would be considered marketing, because, and remember, it says it refers to the general public also when it comes to, I can relate it to advertising also. In this instance, I believe that it's not considered as marketing, but as being your own client, it would be continuous rendering of financial services, because even when it comes to changes in policies, that different, information that should be disclosed to the clients. There could be change in fees, there could be change in benefits, there could be new exclusions. So that is quite important to take note and have the responsibility as the FSP to go directly to the client and would not be seen as marketing. I don't know, Charene, if that's understood correctly there. the
So
question
Martha, I
explained.
agree with you. I also would not regard this as marketing because it is updating the client about the changes in the policy, the wording, and how it would affect them. And then if there is a substantial difference, but there is a way in which you can help the client to still get the same original benefits, then that is additional financial information on a continuous basis. So I'm also inclined not to regard this as marketing, Ian. You might have a client here or there who disagrees with you, and then you would need to discuss this with them. But I think overall, if you position it correctly, the clients would see that this is not marketing, but see this as an ongoing financial service.
Perfect. Thank you very much, ladies. That's my take on it as well. I just wanted to clarify. Thank you.
Perfect. Then, Natasha, you have the honor of being our very last guest speaker for today. So please go ahead and ask your question.
Hi, Charene. Thank you for that. I guess you guys can hear me. I'm struggling with my throat a bit, so sorry if it's not too clear. My question also relates to direct marketing. With COVID, there was obviously this dispensation where advisors could contact their clients via alternative mediums, which in most of the cases probably was Teams that was being utilized. Since then, I assume a lot of the client-facing advisors has continued using Teams and various alternative mediums. So you find where they, for example, contact the client via telephone just to set up some time. The client says, yeah, no, they're happy to meet over Teams. And they actually engage. So the normal face-to-face conversation they would have had with the client, they now have over Teams. Some cases recorded, some cases not recorded. But then they still follow and conclude the sale via the normal paper application form, etc., like they would normally do it when they had to sit with the client. And now you sit with the dilemma of, is this direct marketing or can it still be considered face-to-face? So with CBR also, how are you going to classify this as face-to-face business or other? That's my question.
Thanks, Natasha. Martha, do you want to go ahead?
No, sorry, Charene, I just looking at the definition. But one thing I recall is that the definition is it done predominantly? Is it done predominantly in terms of telephone marketing and whatnot? That would be the distinction whether they're direct marketer. But remember also, I mean, we need to be realistic that circumstances have changed and the new method of communication in place. Not everything can be in person. So now when you indicate that even the records and all those things, they are converted into actual record keepings. And when you look at the code, it requires that you keep records in this sense, and the requirements in those instances. So my view on this, I don't know if Charene would agree with me or not, but my view in this instance, I think most of the FSPs, if not all, are conducted the business in this manner, unlike your small FSPs out there. And I don't think it would fall in the definition of direct marketing and what the intent of the code is meant in this instance, because you will be seeing your client in other means, through other means also, and you will be referred, also resorting to documents. Remember, and also when you do record advice or when you're talking, you're really documenting the information. Like previous speakers, they mentioned that the record advice has many documents. So an email would be part of the record advice. Teams meeting can be recorded advice. Those different ways of recording or keeping record trailing of these documents will be part of your normal FSP and not that of a direct marketer.
Yeah. Thank you, Martha.
Charene?
Yes.
Okay.
So, Natasha, I agree with Martha, and the key is predominantly. So it's going to depend from advisor to advisor. There are some advisors who now mostly deal with their clients in a virtual environment. And if you've changed your mode of operandi to mostly virtual, then you are going to be deemed to be a direct marketer, and you will have to start recording and having a process whereby you can store those recordings. And that can be quite a challenge, because it's not just about storing the recording, it's also about being able to retrieve that recording. And that was also mentioned earlier, is that where you have a recording, you must be able to reduce it to writing. So at least you must be able to watch the recording, listen to it, and you must be able to then transcribe it in some way or manner. So that can be quite a challenge for some of our industry colleagues who have now, without realizing it, mostly moved into being a direct marketer. So each advisor will have to go and take a look at how they are doing business now. Nothing wrong with having moved to a direct marketing approach, as long as they have implemented all the recording and record keeping procedures as a result of that.
Yeah. Thank you, ladies.
It's a pleasure. Puli, we are going to allow you to sneak in a hand, but then we are going to have to cut off. If anyone still has questions, please post it in the chat function. We will monitor it for the rest of the day, and we will respond to questions in the chat function. So Puli, you are now definitely our very last questioner.
Is the best for last. Thank you, Charene. Thank you, Martha, for an informative session. For reinsurance intermediaries, I just needed you to confirm if the General Code of Conduct would apply differently, because certain sections or parts of the Code of Conduct may not necessarily be easily implemented. So I just wanted your comment or your view insofar as application is concerned for reinsurance intermediaries.
So remember the code of conduct, when you look at it, it says it indicates who it applies to. So it applies to financial services providers and representative. So if you're a reinsurer, you are an authorized FSP, this applies to you. Now, some sections might not be applicable to you. Like, for example, we just discussed direct marketing. Not all FSPs are direct marketers. So that section will not be applicable to you. So as a reinsurer, you are required holistically to comply with the code of conduct, but sections that are not applicable to you based on your nature of business and the financial services you render might not be applicable to you.
Great.
Thank you, Martha. To just confirm, I know that in terms of Section 10, that deals with custody of funds or dealing with client monies, there are certain subsections that reinsurers are not held to, so you don't have to adhere to every single section in Section 10, but it's only those sections that you've been exempted from that wouldn't apply to you. The rest of it, as Martha has said, holistically would apply to you. I am going to conclude the session here and say thank you very much to our speakers, to Thandiwe, to Matshidiso, and to Martha. Thank you so much for a very informative session, as well as for dealing with the questions. To all of our attendees, thank you so much. And then to all of our colleagues who attended and participated in attending to the questions in the chat function, we really appreciate this. Without the group work, we would not have had a successful session. So remember that we have a section again on Thursday coming, and there we are going to be talking about FSPs and representatives. And we are recording that session as well. And as with today's session, we will send you a communication link with the link to the recording on the YouTube channel, as well as to the assessment, because that session has also been accredited by the Financial Planning Institute for CPD points. Again, thank you so much for your continued support of our webinars. We cannot tell you how we appreciate that. Have a lovely week. Thank you so much, everyone. Take care. Bye-bye.